Our next guest this morning is Greg Paramor AO, one of only a few industry figures to be inducted into the Australian Property Hall of Fame and who brings more than 45 years of experience across a roll call of the nation's largest real estate institutions. Greg is a non-executive director of Charter Hall Limited, chairman of Leftfield Investments, former CEO of Mirvac Group, former chairman of LJ Hooker, former director of Leighton Properties and former managing director of Folkestone Limited. In addition to these roles, Greg is also a past national president of the Property Council of Australia, a former director of the Green Building Council of Australia and was the co-founder of both Growth Equities Mutual and Paladin. Outside of his corporate positions within the property sector, Greg is also a past chairman and director of the National Breast Cancer Foundation, a position he held for 6 years, and is also a director of both the Sydney Swans and the Sydney Swans Foundation, a role he has held for some 13 years. Greg, I hope my introduction gives you justice. Given your extensive experience of what I've just outlined, what's your reading on the current strength of the Australian economy?
Given the events of the last 12 months, and indeed we've forgotten another event that happened Christmas 19/20, is we had bushfires. So if you just took that as one item, which we tend to have swept under the carpet, which is a bit sad for many people that are still struggling to get their life back in order in those regional areas, and I think that's a real issue for Australia, by the way. But we've had a hell of a 18 months, if you will, or 15 months ride, and I think Australia's been incredibly resilient. I was just musing with a few friends the other day about March last year when, if you remember, the stock market went off south, and I think Charter Hall, which is one of my favourite listed stocks, went from about $12 to $5.30 or something in a day, and you think, oh my goodness, what's going to happen here? And you look at it today, it's about $13.50 again, or thereabouts. And that goes for most stocks. And we've been very lucky, I think, to have had good governance pretty much at the federal level for some time. We've got pretty tough fiscal managers with the current coalition, and they've been, I think, doing a very worthy job of keeping things together. Been mixed at the state level, but we'll get to that maybe not in this interview. But so I think we've done well, and you do stop and think, gee, here we are sitting in the Pacific Ocean, between the Pacific and the Indian Ocean, and we've had a rails run. We didn't have a recession when everyone else did in 08-09, etc. So we've been incredibly resilient, and that's been borne out by the type of economy we have and the type of people we are. So I'm pretty comfortable that we've done better than most in terms of weathering this storm, which incidentally we're not out of yet, and we're probably somewhere in maybe the mid, I hope, towards the post the mid, but we just don't know, we just don't know what's going to be thrown at us. And vaccines are great, but it's not a cure. So we're still going to be stuck with the aftermath or the aftershocks of this vaccine, of this virus, for a long, long time.
How would you evaluate both the federal and state government's leadership and response to the global pandemic, and what impact have their decisions had on the domestic economy, do you think?
I think they've done a very, very credible job, if not an excellent job, which I think I probably should have prefaced by saying it probably is an excellent job. If you look around the world and what some of the other leaders and other governments did or didn't do, I think we've done a heck of a good job. They called it early. If you remember, we shut down flights from China very early in the piece, and then we shut down a lot of international travel very early in the piece compared to most of the world. They responded very, very well, I think. State governments, in my opinion, have been mixed. There's been a lot of politicking involved. They are politicians after all, but it's really sad for me to see that the Federation of Australia is now, very stark, where we used to just assume that the borders were just lines on a map. All of a sudden, they took another significant tact during 2020. I don't think I'll call them out, but there's been a couple that have done a shocking job, and there's been a few in between. And I think that is sad that I'm saying that, because when people won't own up and say, look, I've probably got that wrong, or I could learn from XYZ state as to what we could do better, and that's where politics sit in the road. And nothing to see here, I've done a great job, quote unquote, but I think where I'm probably who I'm talking about.
In relation to the broader property market, particularly in your role at Charter Hall and then also at Leftfield Investments, what opportunities do you see now or in the near-term horizon?
Well, I always look at property as a servant to the community because if people are expanding their businesses, if they're looking for office accommodation, if we've got positive increase in population, we're looking for housing in its various guises. So you always go back to demand and then obviously the supply side. And most of that is in pretty decent shape at the moment. There is some question marks over some residential, particularly apartments. The investor grade apartments, particularly in this city, in Sydney. I really can't talk for the other states as well as I can for here, but owner-occupier residential is pretty much on fire around Australia. You just have to read the stats or read the reports and we know what that's all about, and that's fueled by liquidity. I think people do have pretty decent liquidity, and it's fueled also by incredibly cheap interest rates, which makes affordability less of an issue than it has been in the past when you're paying 6, 7 or 8% on your mortgage and you're currently paying 2% and that makes it incredibly affordable. So I think the markets are in not bad shape, but if you look at where the institutional money's chasing, it's certainly logistics and therefore industrial. Next is office, and it's A or premium grade, city and or in some cases suburban. Which is looking pretty good. Retail's been the outlier. Retail, if you remember, or we know, is the best performing sector in the real estate market over the last 30 or 40 years, but we were seeing a change happening because of e-tailing and because of a changed nature of how retailing's conducted. And I think what we did is take about 10 years of change and put it into a year. And that has affected the top end in particular, the regionals and super regionals. And the winner there has probably been the neighbourhood, or has been the neighbourhood and convenience retail, which is still pretty strong. And whilst the institutions don't play as much in that as the other end of the market, we've seen that to be particularly resilient, a lot more resilient than I thought it would be. And I suppose when you think that people aren't going out to dinner and they're eating at home, then they're going to go to their local supermarket, they're going to go to their local shop. It's convenient, as the word says, but it's also a lot safer than big regional malls, perhaps, where you're mingling with a lot more people. And that COVID impact has certainly come through. And you saw Coles results just this week, which sort of endorses my comments. So they're all looking good. We've had very low interest rates, and therefore the margin on bonds for real estate yields has never been higher, and that is driving a lot of demand globally. And if we look at ourselves in a global context, we've got a very good legal system where our sovereign risk is basically zero, and as a consequence of that, a lot of the major institutions around the world, the sovereign wealth funds, etc., and the big pension funds see Australia as a good place to invest. We've got low vacancies in comparison to a lot of places in the world. We've got an economy that's moving forward. We've been very lucky with our mining, of course. That doesn't occupy a lot of space, but it does pay a lot of wages. And therefore people have been well rewarded by working in that sector, and that's underpinned what we're doing. And we've also we're lucky enough to have some pretty good harvests and, standout performance of sheep and cattle, etc., etc. Notwithstanding a certain trading partner that's not taking certain things, that whole sector's pivoted away from that, and we're finding markets in other parts of the world. And if you like, we've probably been lazy in just accepting that's the easiest market to be in, and now we've got to go hunting a bit, and Australians are pretty good at hunting.
What structural challenges do you see for the property market over the medium to long term, and how should companies be positioning themselves to weather some of these challenges?
I think there's one front and centre at the moment, obviously, is with the COVID issue, is will people come back to the cities? Will they support a city environment which is not just office space, but it's everything that services the office space users, their cafes, their restaurants, their bars, there's doctors and dentists and everything else that go in between, plus retail, and that vibrancy that we've been used to in our CBDs and major regional centres is under challenge a bit at the moment. My feeling is that we will get back to normality. It will take a couple of years. Some industries and some types of workers and some organisations have realised that they don't need the office space that they used to have, I'm talking particularly about, call centres, for instance, where you can monitor a worker in terms of output, etc., very easily electronically these days, so you don't have to be in one spot. And companies have been doing it elsewhere in the world for decades, really. Southwest Airlines out of the US, I think it's been 20 years where their whole workforce, or everybody doing bookings, they've had a predominantly female workforce spread around America. They set that up decades ago and never had to put a call centre in. So I think some of those industries will change, but I think it's very hard for people to learn and therefore companies to grow and nurture their young up and coming people on a Zoom call. It's very one-dimensional. And it works for a while. It worked incredibly well last year. A few old blokes like me had to learn about electronics very quickly and very frustratingly. But we got through, and it was fantastic. I mean, the spirit about still conducting commerce last year was phenomenal, I thought. But I think people will need to come back to the cities. But that is a challenge. And will people? A lot of large organisations are talking about whether people can, be two days here and 3 days at home, or vice versa, etc., etc. I think part of that is here forever, and that's going to change the dynamic of office usage. At the same time, I think social distancing is probably here forever too, and I think people will be very wary to go back into the battery hen type of space that we used to have, and there will be more space per human. So that might be a compensating factor. That's going to challenge it. The flip side of that is we still have relatively high take-up of space. Our vacancy factors in Melbourne and Sydney are sub 10%, and I always call a market an equilibrium as 10% is fine. You don't want to be much higher than that. Brisbane, Perth are heading towards 20%. I'd call that a higher risk. And then some of those other challenges are electronic challenges, if you like, or internet challenges, where how much space do we need, or can we move to more e-retailing and other forms of remote work and those sorts of things. I think that's a big risk. Or a serious thing that's got to be addressed. I have some views, I've already expressed them, that I think people will go back to wanting human interaction. I just don't think even whatever the generation is coming through, that first thing they do, and which I find myself doing in the morning, is you turn on and you don't need to communicate with anyone, but it's very hard to conduct your life like that, so I'm optimistic about that. We've got some challenges geopolitically obviously with China and their issue with us, and I guess ours with them. I'm not qualified to say how that's going to play out, but obviously we've got to pay attention to that, and I'm sure our government is paying attention to it. And we have some other geopolitical issues, around the world that are outside our control. So that's always a constant. We can do certain things internally, but at the end of the day, if the world moves in a different direction, or for whatever reason there's an incident, then that's going to obviously impact. But taking that off the table, the headwinds are just one really of getting Australia back to work. And I think, and I know the Morrison government is working hard on this, is saying let's get back, let's for heaven's sake stop just digging the stuff out of the ground and putting it on a ship. And I've been saying this for a long, long time. I've seen it, and as a Western Australian, or former Western Australian, I grew up with that start of the iron ore boom back in the 60s, and the whole mining thing that grew up at that time. And it's always been frustrating that we haven't been able to value add on the way through. And I know I hear now people talking about that, and I'm very keen for that to happen. And the other very opportunistic thing for Australia is there's a lot of wealth, there's a lot of companies, there's a lot of people that are looking around the world, and they're living in the US, or they're living in parts of Asia, or they're living in parts of Europe. And they're saying, is this where I want my children to grow up? Is this where I want to be? And we're starting to hear about it now, where people are starting to want to come to Australia. Immigrants with big ideas, lots of wealth, and lots of ideas that can help this country get to where it needs to do, which is to be a very high-end manufacturer, or manufacturer of high-end, highly sophisticated and challenging things. Can't think of the right term, but particularly in medicine and other areas that we can really excel at, because we do have one of the best education systems in the world. We have a country that's a very safe place to live. It's right right spot really in between the Indian Ocean and the Pacific Ocean, and with Asia to the north and to the west of us. We've got South America and the USA and Canada to the northeast of us, of course. So I think we're in fantastic shape. So yeah, there's issues, but I'm very optimistic about our future.
You touched on it there. Let's discuss Greg Paramor, the person. You were born in Western Australia's Margaret River. Take us through your upbringing and your earliest memories.
I was born in Margaret River, and I didn't grow up in Margaret River. Father and his brother actually went farming after World War II. They were returned service people and chose after a period of time to leave that. So I grew up in the southwest of Western Australia, in Perth for a period and in country areas near Perth. My father was a stock and station agent, so he tended to be transferred from one place to another. So it was a normal upbringing. My brother's 10 years older than me, so I was a bit of an only child, which made me quite selfish. If you talk to my wife today, you know, that's the way it is. But no, I had a pretty normal upbringing, nothing out of the ordinary. And you know, when I look back on it, it was interesting, but I probably should have achieved more out of my early life than I did. A bit of a bookworm, and I probably, you know, should have. What you don't know, you can't work on, but you know, it was pretty happy.
You did have a unconventional pathway into the property industry though, in that you left school at age 17 to join the workforce. Take us through this period of your life, and why were you so eager to leave school and start working?
I didn't know what I wanted to do at university, so I was sitting at home and my father said, I think you need to go and buy some shirts. So I think he might have organised that. And he'd organised for me to start, and this was in a little country town called Beverley in Western Australia, and there's the local bank, or one of them was the ANZ. So I found myself fronting up to the ANZ bank one morning with a fellow that was the branch owner, Mr. Teed, who turned out, a friend of my father's too, but turned out to be a fantastic teacher and a wonderful man. So I had 12, 15 months there, and then I moved on, and I wanted to get away from the country. I wanted to get to the bright lights of the city, all 800,000 people in Perth or whatever it was back then. And I joined a finance company, Lombard, and I was with them in Perth and then moved to Melbourne for a stint there. So that was my training. I did a number of diplomas and things along the way, but I never went, unfortunately, probably never went back to university, which I probably should have. But anyway, that's life.
Following roles in finance and the rental car industry, you purchased your first business, a news agency, at age 21.
Done your homework, yeah.
How did this opportunity come about, and how did you find the experience of running your own business?
Oh, yeah, well, that was a family thing. I was living on the East Coast, and I think particularly my mother decided I should be home, so they bribed me with some money for my brother and I to go into business together, which worked okay for a while. I didn't last long. Two people 10 years apart with totally different perspectives on life, one being 21, which was me, and my brother being 31 with a couple of kids. But that all worked out, and we're still good friends. So I moved from that, and I was sitting on a boat I had, and I thought I'd better go and get a job, and I applied for a job in leasing, which I actually thought was finance leasing, which I knew a bit about. And so I applied and found it was a commercial real estate agency called Milner and Company, which became Knight Frank down the track, and fortunately got the job, and that was it. I just fell into an area that I just really loved. I loved servicing my clients, and I was in leasing, mainly more than anything else. And we did all the modern office buildings of 1973, I think, and there were 3 new massive 33-level towers in Perth going up, so that was interesting. And the first regional shopping centres, we did Karrinyup Shopping Centre, there was Carousel on the south side, and lots of industrial. So I sort of got into commercial real estate, went to night school, just decided this is what I wanted to do for the rest of my life. I loved it. So I did some training, as you need to do, but I also trained on the tools, as it were, and really got involved in the cut and thrust of, and it was great getting into leasing because you get to understand what people's business is, because you're actually leasing them either retail and getting to understand what their business dynamic is, getting into offices as to why they're there, why they're expanding, why they're contracting, what they do. And industrial was the same, albeit that was, there were smaller sheds back then. So that was fantastic, and that was, that's how I stumbled into this area. And then from there, after 7 or 8 years, one of the directors had left the firm and was developing, and his name was Dick Lester, and he invited me to join him, and I did that, and we did a range of developments from Karratha and the Pilbara, which was all about iron ore and gas and salt and stuff, to small retail and some commercial and some residential, and from there we developed, which was Dick's idea, but Growth Equities Mutual, which was one of the new breed of unlisted property trusts, which we launched in 1981.
In 1981, as you said, you founded a company, Growth Equities Mutual, with Dick Lester. What was your mandate?
Well, in those days we were developing, and we said, gee, if you looked at those that have been successful, it was really Lend-Lease and GPT, because Lend-Lease developed it and put it on GPT's balance sheet. So that seemed to be a pretty good model, and whilst we were developing little things, we thought, well, if we have a fund that will allow us to, control our destiny rather than put something on the market. Now, bear in mind, back in 81, 82, 83, interest rates were well in the teens, and when we launched GEM in March 1982, I think it was, interest rates were 21.5%. That was the bill rate. So you try making money out of real estate when you're rolling bills, 90-day bills at 21.5%, and it was pretty interesting. Somehow we got through that. A lot of people did, and a lot of people didn't. Should we go listed? Should we go unlisted? The institutional market just was nothing like it is today. It was dominated by AMP, National Mutual, City Mutual, all the mutual life companies. They were just getting into investment property in the late 60s, early 70s, and they were just discovering the cash flows that you get from these types of investments. We decided to go into the retail investor market and go unlisted. So the Growth Equities Mutual Property Trust, which we grew over the 80s, first year we raised 4.4 million. By year 2, when I arrived over here, we had 20.3 million under management. So they weren't big numbers. We didn't eat a lot of caviar. We certainly didn't drink any bottled wine. And, it was food parcels from parents in the country, and Dick would kill a few of his cows that he had roaming around, and I'm not joking, that was the way it was. So that was it. So in 84 I moved over here. We just said, if we're going to make this work, one of us have to come east, and fortunately he had kids at high school, and we had our firstborn. So Kerry and I came over in 84 for a couple of years just to see how it was, and that was 36 years ago, whatever it is. So it worked, and we grew GEM from 0 to about 1.5 billion of equity and no debt by the time 1990 came around, which was the crash of 1990, which was pretty horrendous. But we sort of managed to get through that, and I then moved on to do other things.
As you said there, just over 10 years later, in 1992, you sold your stake in the fund, by which time it had become Australia's largest unlisted property trust, worth around 1.5 billion. How did you manage that level of growth year on year?
A lot of hard, a lot of sleepless nights. It was. You look back on these things, think, yeah, how did we do that? But I don't know. We grew. There was Dick and myself and 1.5 people at the beginning. I think we had 200 staff at the end, and we had an office in Brisbane and one in Melbourne, one here and one in Perth. And we're pretty lucky. We hardly turned over any staff. We had terrific people. We were able to recruit really good people. I think one of the key things about that, our business, was we put our investors first, which when the crash came in 1990-91, we had a very honest communication with our investors about we had 80,000 of them, what was right and what was wrong and what was happening, as best we could answer those, where a lot of our competitors didn't speak truthfully to their investors. It's still perhaps the case today in some cases. It was a great marriage between Dick and myself and energy. He stayed in Perth, although we both travelled a lot. We just built it brick by brick. And I think when you are at the first time when you're doing the first distributions, cheques were done on my lounge room floor. Kerry and I were putting them in envelopes and posting. There weren't many of them, posting them out. You can sort of do that. So it was really exciting. It was fantastic. Yeah.
Next came the launch of Paladin in 1994. One of your acquisitions during this time was Melbourne Southgate Towers. Walk us through this particular acquisition and also Paladin as a business. Was it different to Growth Equities?
Yeah, I had a very fortunate time then, because when I sold out of GEM and before I started Paladin, I had a time where I just, you work hard for a long period of time, 11, 12 years with GEM, and you're pretty exhausted. And I had 3 kids by that stage. I had a Kerry who had all the nurturing. It's a lot different these days, but she did a great job. And I was lucky enough to not have to, go and get another job. So I just did sit down and write down everything that was on my mind at that time. Everything that had gone through your mind in that whole build-up. I wonder if this, should I be doing this? Did I really want to do this job? All those things. And I was, how old was I? 41 or something, 42. So I had the luxury of time, and I just took that time. Fortunately, I wrote all that down, and when I scrubbed on my whiteboard, and I scrubbed everything off, I ended up with 2 things left there: funds management and property, which I'd already been doing. I thought, well, that's what I'm going to do next time. And I then took a year off. And during that time, it was fantastic, because I got to know my children, I got to know my wife a lot better, and I had the luxury of just, sort of thinking it through. When you first find yourself by yourself, there's a tendency to rush in and do the next thing, particularly when you're that age or my temperament. And I was lucky enough not to do that. So I looked and we thought, and Rod Lever, who'd worked with me before, joined me, and he co-founded Paladin with me. And we looked at the marketplace, and I felt that the unlisted markets were very tarnished from what happened in 91, 92, 93. And there was a lot of issues around the whole unlisted structure, which is another topic for another day, but we had some issues with the regulators back then, the way they were structured, etc. But GEM, fortunately, we got through that pretty well for our investors. Not without pain, but with a lot less pain than lots of others. So the market was moving to listed, so that's what I was attempting to do, and we attempted to list an industrial fund, and interest rates got in the way of that. We were looking at the accommodation industry with hotels. We ended up pulling out of that. And I actually got a call from Westfield, who said, why don't you pop over and have a chat, which I did, because I knew them reasonably well. And they were wanting to buy a particular asset in Victoria. And part of that deal was doing Southgate, and they knew that I was setting my business up. They didn't want to do that because their retail they had a little bit of retail, but not a lot. And I was able to convince the vendors of that we were worthy of support, and we set about on a conditional contract to have a capital raising and have the listed Paladin Commercial Trust, which launched with Southgate. We created the Paladin Industrial Trust as well, because the market had moved that way. At the same time, we also recognised the syndicate market was starting, so we had a number of syndicates we launched during that time. We had a very large REIT securities fund. GEM had been the first group to start a property securities fund to bridge the unlisted and the listed markets together, with a universe of 15 stocks. And then I created a Paladin property securities fund, now called REIT funds, and we raised about $1 billion, I think, for that. Some institutional, some private. So we moved from just the pure retail investor market to the institutional market was backing listed. And we grew Paladin over 6 or 7 years to about $2.5 billion or whatever it was.
And by this stage, and for a second time in your career, you grew Paladin, as you said, into a multi-billion-dollar business before selling to Deutsche Asset Management, which later became Dexus. What was involved, do you think, during the growth stages of that business? How have you, there's 2 times in a row now that you've managed to grow businesses into multi-billion-dollar enterprises. How have you gone about that, and particularly in the Paladin case?
I didn't write the script on either of them. We tended to write the script after we'd done it. But it's backing, I think, your judgment that what you're doing. Reading your market and knowing what the market wants is one of the fundamental things that you need to do in funds management, no matter what you're doing, particularly real estate. There's no point in giving people something they don't want. And in 1994-5, when I was trying to get Paladin off the ground, they wanted listed or liquid securities. So that was point one. Point two, once again, you always got to get good people. If you don't have good people, and people with the right attitude and the right approach to their investors as well as the job in hand. Rod was a terrific co-founder. He did what I couldn't do, and probably vice versa. So it was a great partnership for that period of time. And once again, we built a team of people around us that, you know, were pretty good. We didn't have too many failures. I think also, I've always been a great believer in having fun when you're doing this. And I don't mean what's having fun. Well, I just love what I do anyway, so that makes life easier. And you garner and gather people around you that I think you automatically get to people that want to share that vision, that opportunity. And I was able to get good people. You get good people and you have a crack at it, you probably got a decent chance of getting there, provided that you make sure you understand the market you're in, you make sure you know the investor market, you make sure you know the property market, and you're prepared to pull out of things as well.
Less than a year later, you then launched James Fielding Group, your third business. How did this business differ from Paladin and Growth Equities?
First of all, it's a stapled security, which most of the big funds are now. Big groups are. So we stapled a trust. So I had a little, what Deutsche didn't buy was a little trust that I had a joint venture with a couple of friends of mine in Perth called the PA Property Trust, and they were keen to sell. So I bought them out of that $60 million fund. And we used that as the launching pad for James Fielding. And that was to have a stapled security where you had the trust and the company stapled together, an opco-propco arrangement. That's all the norm. The only ones that were there ahead of me was Stockland, who'd done that for tax reasons years and years before, and Mirvac followed because they couldn't get traction in their pricing of either their trusts or their company, and by bolting it together did. And I thought that was an interesting way to go and something I believed in, so we did that. And my aim then was to have a capital light model, so we didn't want to swamp it with capital raisings. We created funds off the back of that, so we built that quite rapidly, I guess, over a few years from whenever it was, 2001 to 2003, yeah. So it was a $400 million market cap with about a $2 billion development pipeline and about just on a $2 billion funds pipeline for various things at that time as well.
Nearing its 3-year anniversary, as you said, James Fielding Group, with you at the helm, was purchased by Mirvac in a $478 million deal. What are the fundamentals required to position a company as an attractive takeover target, and what are the ingredients to effective decision making?
I've never started a business with the idea of selling it, but I've learnt that if somebody has a greater need than you, then perhaps that's not a bad way to go. Now, there's people who have very different views that want to keep one thing and just grow it and keep it there forever. I've never been an active seller or never created James Fielding or Paladin or Gem I sold out of, but then sold it to Lend-Lease a little later. But I've never created anything that I've said, I'm going to sell this in 3 years' time or 5 years' time. I wish I still had Gem, that's what I probably wish. The circumstances lead you to do different things. Paladin, it was market. What caused us to look at that was institutions were making it harder for independents like us to have a management company that owned the management rights of a trust that was listed, so they could go and buy 20% on market and then kick you out as manager. So that's very damaging in terms of your hip pocket. So when Deutsche came knocking, I thought that was a good opportunity to see what they had. We did a deal directly. We didn't go and shop it. Some people would do it differently. They'd try and get maybe another penny or two out of it, but I was very happy to take the price that we negotiated. It was good for the shareholders and therefore me, and I felt also very good for the unit holders, because first and foremost, if you put your investors first, your staff second and you third, you probably win. If you put yourself first and everybody else somewhere else, you might win, but it's a shallow win, if you like, because if you've got to look after your investors first. And I learnt that way back when, during the crash of 1990, we really had focused on our investors. We'd built up a lot of cash reserves, we had no debt. We're in really good shape despite the fact that the market toppled over that, maybe you could see coming, but most didn't. And so back to to where we were with James Fielding. That was Mirvac, Mirvac knocking on the door. The people that had been there, particularly Bob Hamilton, asked if I'd be interested in buying James Fielding, and me and my team basically taking over the management of Mirvac because they wanted to retire, plain and simple. It wasn't on the agenda. As a matter of fact, I'd had a time away with my board a few months before Bob made the approach, and I was talking about handing over to my 2IC and starting to step back and taking it easy a bit. I was very young then. I was ridiculously too young. And then Mirvac came knocking, and I thought, why not? I think this will be great for my shareholders. They're going in from a sort of $400 million business to a $3 billion business. I did like Mirvac. I'd respected Mirvac. So that was great for the investors. For my staff, they all got really good jobs out of it and ended up doing great things either there or moving on to do other things after a period of time. I got to run a large company, which I never set out to do in my life, but it was interesting and challenging, and I learned a lot, and hopefully did some good along the way.
You became the CEO of Mervac in 2003 and led the business for 5 years until 2008. What's it like being the CEO of an organisation of a company of that scale, and how would you evaluate the strength of the business today?
Well, I think it's very different to go in when it's been sort of run by one group of people for 20 plus years. So because whether they wanted me to make changes or not is a moot point, but I felt it needed changes, and I had a direction that I wanted to take it. And it was pretty hard to get all that to happen because people get very set in their ways, and they say, oh no, we've always done it this way and this is the way we want to continue to do it. It's just a mental thing. It's the way it is. So I found it quite frustrating in some ways. I made changes as I could, but you're steering a pretty big ship that takes a long time to turn around. But we managed to, do some innovative things, and I'm very much focused on the funds management side of real estate. So I was pivoting Mirvac to that way of thinking, and that's continued, which is great. And there were some other initiatives there. So there was a lot to do leading up to 2008 when we had the GFC. I'll be judged by others because I enjoyed it. It was challenging. I hope I did some decent things there, and the share price during my journey was reflected that the business was going well. I had given notice to my chairman a year and a half before I left, that I wanted to wind back in a couple of years because it was time to move on. I retired just before. The GFC was well and truly underway, but it really bit after I'd left. So I left it with Nick Collishaw, who took over from me, who was with me at James Fielding and before, and he did a very, very credible job of taking it to the next stage and also turning its course more to office, which has been very beneficial to the company. So how's it going now? It's going really well. I think Mirvac's a great organisation. It's well led, well governed, and I think it's a household name pretty much, and doing a good, credible job.
What's your reading on the asset class mix of large listed property groups today? Do you think they're underweight or overweight on any particular sector?
Well, there's sector specialists, so you've got a lot of overweighting if you're only in office or you're only in retail. If you take Charter Hall, it's been de-weighting its exposure to retail, but up-weighting its exposure to industrial, logistics and office over the last few years, because David Harrison, who is second to none in terms of the ability to manage that ship, he's been moving that way, and that also reflects in part what I was saying earlier about what people want. You've got to respect what your investors want, and Charter Hall, with nearly 50 billion of funds under management, really responds to the needs of its community of investors, both wholesale and retail, and obviously takes its own view, which is debated widely, and as a board member we get to discuss it and interrogate whether it's the right course of action, but it will move where it needs to be. So the sector specialists, or those that have chosen particular paths, and there's a number of them at office and regional malls, they've had a bit of a tough trot. The pure office funds similarly have been beaten up a little bit over the last 12 months, probably offer some pretty good value. The pure industrial ones have been well bid because Everyone wants to be in industrial at the moment. The beauty about that is investors coming into the listed market can pick and choose what they want, and you can get whatever you want out of a range of stocks that are listed on the market. So you can make up your own portfolio, or you can buy into a diversified fund like, I'm selling my book here, but Charter Hall Long WALE REIT, which is focused, it's got a lot of industrial, office, some retail, particularly convenience-based retail, and other specialised long WALE, long leases, government-backed, etc., etc.
And your involvement in Charter Hall came through via Folkestone Limited, which was another company you founded in 2010 and sold to Charter Hall Group 8 years later in a $205 million deal, making you a non-executive director of Charter Hall today. What is your position at the company involved? And you have sort of touched on it, but how would you evaluate the strength of the company's balance sheet today?
Well, they reported yesterday, and it was a terrific half. Share price went down, which I can't often read the markets, because why would it go down when they've just had a great year, but some said it should have been greater. So during the whole COVID thing, the way that Charter Hall was able to still grow through this last period of time says a lot for the organisation. It says a lot for the confidence that investors have in that organisation. So it's incredibly well-led, well-governed, and has positioned itself to those markets that, you know, outperforming many others. So the sale of Folkestone, that was Folkestone, when I took that, it was actually a listed company with about a market cap, I think, of about $8 million. We took hold of that. We went and bought a business, and I'd been in childcare centres a decade before, built a small portfolio of about 50 of them, and were able to negotiate with a group that had the management rights for the largest childcare centre group, and we bought that, and then we grew that from, I think it was $400 million worth of childcare centres to about 1.1 or 1.2 billion when Charter Hall knocked on the door and said, would you be interested in a deal? So going back to the way I think, I thought, well, is it good for my shareholders? They're going to get cash. They're going to get... The biggest problem with the micro cap, as we were at $200 odd million, is you get to a stage where the market loses interest in you if you're too small and not growing at a particular rate. And if you're doing that, you might be doing things that may affect you later on. So we were being very conservative about the way we were building that. And the growth that we'd seen in the share price had started to level off, and therefore the IRR that I was chasing for me and my shareholders was such that, you know, it was starting to fall behind. So I looked at it, I thought it was timely to consider that. Dave Harrison and I sat down. I had an idea of price, he had an idea of price. There was a few pennies between it, so we shook hands and did the deal. And my shareholders did really well, because they were just shy there. What I wanted to do was a 15% IRR from go to woe. All my staff got employed at Charter Hall, bar one or two that wanted to leave. I think there was one redundancy, and they're all gainfully employed and doing their thing at CHC, which is great. They asked if I would join their board, which I was very happy to do. It wasn't part of the deal, but I've enjoyed that encounter over the last couple of years because, as I said, they're a very well-run, driven organisation that do great things.
Now, as I mentioned in the opening, you're the chairman at Leftfield Group, where we are today, a multidisciplinary investment manager with interests across the real estate, private equity and venture capital sectors. Where do you see the greatest opportunity for investment currently? Well,
I wouldn't say where I see the greatest opportunity for me and my family is the things that appeal to us to do. So Leftfield is basically our family business. So we're invested in property debt at the present time. We have a small company called Tier 1 Capital with some friends of mine in Melbourne that we started up in December 2019. So it was an interesting journey trying to all of a sudden use Zoom. Haven't been in Melbourne since March last year. So we lend money to property people that the banks don't lend money to, money developers, small end. We have a following that we put it out to our investor network each deal. We underwrite it, so we've done the deal, but if you'd like to come in, these are the metrics, and we fill those up with our people that are recycling. So they're all short-term, 12 months, 18-month deals. We are also in a venture with Achieve Australia, which is a SIL provider or disability accommodation group. They were looking to get out of their property holdings, which we've taken out of Achieve, into a company called Inclusive Housing Australia, which we own alongside the Achieve people. And we're attempting to build a portfolio of residential property for people with disabilities. That's under the NDIS, NDIA regime, National Disability Insurance Scheme, etc. And we see great opportunities. Incredibly complicated and incredibly hard, but the beauty of when you get to my stage of life, I can do things I want to do, and not being arrogant, there's a little bit of good in doing. If we can do this properly and create a better environment for those people unfortunate enough to have a disability that causes them to be in this position, then that's a good thing to do. So they're the main things. I'm also involved with Eureka Group, which you didn't mention earlier. They're also listed, and we've got a holding in that organisation, and they provide accommodation for mainly people on a pension. So we've got 40 villages up and down the East Coast and in South Australia, with about 2,500 apartments that we're growing and developing there. So that's my focus. We've obviously got investments in listed organisations like Charter Hall and others, which are part of what we do, and the private equity piece, we use experts to do that, because I'm not expert, neither is my family or my employees. Yeah, so we're just going where we want to go at the moment.
Just on disability accommodation or disability housing, as I understand it, it's quite a complex sector. It's not sort of a get quick rich sort of scheme or anything like that. Tell us about some of the intricacies involved in the sector, or how difficult is it?
Yeah, well, I'm still learning. Thank goodness I've got some good people that know a lot more about it than I do. But it is very complex. It is attracting a few cowboys. And there's a lot of talk about, oh, you get into this and you can, make it an awful lot of money. That is not just for people that are thinking of investing. Be very careful who you invest with, and go into it in some detail. So it's complicated. You have to get funding via the federal government agency that was brought in the Gillard government, I think, and it's been sorted out by the current coalition. It's a well-run scheme. I know the people in both on the board and the executives, and they're very competent people, but it's a very complicated place to get funding, and it comes at a number of levels. And it's also very complex because of the people that are involved, the customers, the people that are going to occupy the bed or the room, or, and they'll either be in a house that might have 3 participants, they might be in an apartment by themselves, and it's obviously different levels of requirements, from whether they're mentally affected, physically, or both, or if they're people that are apt to be violent and they need particular properties, etc. The whole initiative is around keeping people in a non-institutional environment so that they're salt and peppered throughout the community, which is a good thing. It does come with some complications there that I think they're better off to be clustered in some ways, because it's very expensive to keep them like that. So it's just got a lot of layers on it in terms of, if you develop something that's capable of being utilised, you've got to get an approval for that, an SDA approval. It's got to get a tick, which is quite a thorough process in terms of making sure it's ready for occupancy. You've got to get a participant, and if it's a shared environment, particularly if it's more, and the government agency would like people in 2 or 3 bedroom accommodation, 75% of our people that we survey, the people that we look after and others, want to be, 75% of them want to be by themselves. They want a 1 bedroom apartment. And they have carers, they have social workers, they have families that all participate in that decision. If they're of able mind, that's one thing. Yeah, they can tell you what they want and why. If they're not of able mind, and unfortunately a lot of people in this area aren't, then they're relying on a lot of people to give them the right advice, and they're relying on their judgment. So it's very complicated. I think we'll get there, but it's a long and difficult course. But at the end of the day, and it'll take 5 or 10 years to work its way through to get the model absolutely right, I think, and there'll be some missteps along the way, but it's a worthy cause.
There'll be a lot of developers watching this, so I want to get your insights from a Tier 1 capital perspective. What asset classes or what types of development are you funding or not funding at the moment?
We're quite flexible, and we tend to be sort of Melbourne, Sydney, just because of the nature, and COVID sort of stopped us moving around much, and we've tended to be, suburban Melbourne and suburban Sydney, and we're looking as far up as the border, I guess. And we're doing, our book would be about 60% residential, about 40% mixed-use industrial. Mixed-use and industrial. And we see each deal on its merit, so we haven't got a specific, we've got, because each deal's its own deal, it's not a pooled arrangement. We're not trying to have weightings this way or that way. We take a deal, some of our investors will say, I've already got too much in Melbourne, or I've got enough in Melbourne or enough in Sydney, and I'm looking for X. So, they'll wait for the next opportunity. So most of ours are small. We only do small deals. We're not competing with the big guys, the Qualitases and those that, really, really good, and they've got a far bigger balance sheet and reach than we have. So we're doing basically sub $10 million deals. And we're very happy to do that. We've probably got a $100 million book now that we built in this last 12 months, and we're just ticking that over, and we don't have to rush it.
And what do you look for from a developer? I mean, you obviously look for a good relationship, you look for a track record. What else?
Both those things. I think, have you done it before? Some people haven't. You take a lot of interest in how that's being done. If we're doing construction, which we do, QS and following the payment system is vital to get that right. We've got really good people doing that. If it's land acquired for development and we're just doing that component of it, we will obviously look for the track record. It doesn't mean to say it has to be, you've got to have a long one, but we've got to be satisfied you know what you're doing, and we will spend time working on that. And the relationship with the borrower is vital. We more and more are looking to, building those relationships so that they will come back to us, and we'll be confident that they know what they're doing, and we'll be bold enough to say we don't think that's a good deal, or we're not going to do it, but why would you? Those sorts of things. So pretty interactive with that, and that's also because we've got to make sure our investors, know that we're working very closely with the developer that we're asking them to back.
Now, you've been very generous with your time, so just 2 or 3 quick questions to finish. Outside of property and your corporate interests, how do you keep yourself busy from a philanthropic perspective?
Yeah, I've got a few areas that I'm involved in at the moment, and I like to have sort of 3 things. I guess I don't put the Swans into that category because that's a passion. And I hope a good one this year. We don't like finishing 16th. So I'm involved with Backtrack. Backtrack is a group based up in Armidale run by a fellow called Bernie Shakeshaft and his team of people. I got involved with them about 5 years ago, and we split them out of a group that they were with up there that had backed them in the early days, and we got them DGR status, and Bernie's just does a wonderful job with people, youth at risk. Anyone can look up Backtrack, and I won't tell the story because you can get it on the internet, but it's a good story. And the Garvan Institute of Medical Research, which I've just rejoined their foundation, which is the fundraising side. I was on the other board for 12 plus years, a number of years ago, and I've just rejoined their board, and they do amazing things. And in this era of COVID, to have one of the leading immunologists as our head is Chris Goodnow is terrific. And the Garvan does amazing things, as most good medical institutes do. But that's a worthy cause. And my third one's the environment with the Nature Conservancy, which we do work around Australia in reef restoration in the southern states. We're doing a lot in Port Phillip Bay actually, and Corio Bay, just putting the reef back so people in Victoria can go fishing again. In Western Australia, South Australia, just starting to do some up here, and we've a water fund in the Murray-Darling, which is a for-profit arrangement, and we do work in the Northern Territory and Kimberley, and with the Indigenous groups there with CO2, carbon and burning and things like that. So they're my three things that I've got just enough time to do and find it really interesting. So it's a nice diversion from commerce.
And my final question is, as I said, you've been on the Sydney Swans Football Club board for some 13 years now. What's it like being a board member of an AFL club, and what are the big issues this year for an AFL club, be it the Swans or anybody else?
It's a privilege to be there, number one. The board, led by Andrew Pridham and before him Dick Collis, has been well led, both at the board level and at the executive level. Now Tom Harley taking over from Andrew Ireland. So, you know, we're very blessed with the people we have, and we've been through a terrifically difficult year. We had to get rid of about 30% of our staff. And there's nice ways to say it, but I don't think there's any nice way to say that you've got to let people go. It's horrible. But we were forced into that position, as were all clubs. You know, I think all the clubs did a fabulous job during 2020. If you think about the hubs that were created, the dislocation with families, people, you know, players young and old, and coaches young and old had to, you know, go away for weeks at a time. It was very uncertain, very challenging for some people and some clubs. All our people rallied together, so I'm really pleased with the way that worked, and you know, they really did pull together. And the energy in the place, I've never seen it as high as it is at the moment, in terms of we're going to get this and we're going to work through this and we're going to come out the other side. So the whole of the AFL is under pressure. All sporting groups are, you know, you just the tennis, God knows how much they're going to lose on that. Rugby's the same, etc., etc. So AFL with, you know, was in a lot better shape than most other codes, although we're burning through a lot of money, and we were lucky enough to inherit Marvel Stadium, which gave us a great asset to use in this time. To be able to use as collateral for money that they might need. And I won't speak for other clubs, because that would be wrong. There's some really well-run clubs that I think are fantastic, and there's, like every organisation, you have your winners and your losers, and I'd like to think that the Swans are one of the winners, notwithstanding that it's a really tough gig. You know, where our turnover went from about $55 million to about $32 million, you know, in those uncertain times. And a club like ours at 55 million turnover was breaking even. We don't make a lot of money each year. There are a couple of power clubs around Australia that do, but most of us live on that sort of knife's edge. But we weren't in debt until this year. We're carrying a little bit of debt, which the AFL are funding, and we would hope to be out of that, you know, fingers crossed and everything crossed, by the end of 21, assuming we'll get a reasonable go at, you know, 50% crowds, and we'll get a season. That is still way up in the air at the moment. No one knows. You know, it's not a matter of saying I know something that someone else doesn't. We just don't know. If we look at the way states have reacted to shutdowns and lockdowns, you look at the way Western Australia's behaved, etc., then, you know, anything could happen. So all clubs, we are very aware of that. We're planning to, we're not even wildly optimistic. We're just planning to get through, you know, with sort of 50% of what we hope to do in terms of crowds and those sorts of things. If we do that, we'll be in good shape. If we don't, we've got other contingency plans. We'll be okay, but we'll still be in debt at the end of 21. That's not a position we like to be.
Greg Paramor AO, industry legend, thanks so much for your time this afternoon. It's been a pleasure.
Thanks. For me too. Thank you.